minimum, but because we've got the Fed cutting, and they started in September, they've been on pause all year. That only happened twice in the last 50 years, which is 1998 and 2024. I actually think the S&P, given the skepticism that's been plaguing this market all year, we could do far better than 4%, maybe even 10% into year end.
We are gearing up for one of the most aggressive 3-month rallies, at least bare minimum, that you have probably ever seen. In today's episode, we're going to be going over exactly why that is. From my opinion, from what I'm looking at, like the VIX EQ versus the VIX, the progress I'm expecting we're going to make with China soon, getting back to the table with Canada on trade, earnings this week from the Fed. Yeah, it's all but confirmed. If you watch this video, please let me know the bear case for the next 3 months, because I'm missing it. Like, we are about to have a more aggressive rally than most people would even believe. Even the bulls are going to be surprised by this. Okay. And I know a lot of retail investors right now are bearish. A lot of them are in cash. They're on the sidelines. They got puts. They're shorting this market. Okay. This could quite possibly be the worst time to be on the sidelines and or short this market in a very long time. This is going to be a smack in the face to a lot of people. And hopefully not to you guys if you watch this video. Now, also in this video, beyond earnings next week, the Fed, progress on trade, the VIX, all of the signs that are leading to this rally, I want to share with you what Tom Lee and 314's research Warren Pies, by far, he's been the most correct person on this market this year, is saying about an end of the year rally. Tom Lee suggests 10% upside could be in the cards. That could take the S&P all the way up to about 745. But I think the risk on areas, momentum areas, AI, quantum, some of these areas that have done well recently, not as well the last couple of weeks, are in for a big rebound. So we'll talk about that as well. Now, Warren Pies says, really? You have no choice but to be bullish into the end of this year. Like, you literally have no choice. So we're going to cover a lot in this video. Hit the like button as well as subscribe to the channel if you have not done so already. Check that link out down below in the description of this video. We are going out and finding the Palantirs, if you will, at $10 a share and investing in those companies. The hidden gems, the stocks that Wall Street are ignoring in the AI trade, that is where we are executing. And I believe the next 3 months could change a lot of people's lives in the trading community, and for some of you guys that are investing kind of alongside us at the same time. Now, I'm not a financial advisor. I'm not a financial planner. You have to make your own choices. The strategies we are doing in the trading community, you don't want to mortgage your home to do these strategies, right? You don't want to throw away your 401k and throw all of your money into these kind of stocks, because they are a very high risk, high reward strategy. But I think the real risk is not capitalizing on this opportunity. So with that said, ladies and gentlemen, let's get started. Well, first and foremost, like I talked about on this channel, let's pick out a date here, okay? Let's look at September 2nd, okay? If you look at September 2nd on the VIX EQ, okay, on the VIX, I should say, the VIX EQ is the equal weight VIX. So it's really measuring single stock volatility, okay? How much fear there is in single stocks. The VIX EQ was at 33 on September 2nd of this year. Today it's at 40.17. So it's over $7 higher today than where it was on September 2nd. Look at the VIX. Okay, the VIX today is at 16. We'll just say $16.37. On September 2nd, the VIX was $17.17. Okay. So the VIX was higher on September 2nd than it is today. The VIX EQ was a lot lower on September 2nd. So what does it mean? Well, there's actually a record spread between the two right now. You've never seen another time in the market where there was so little fear in the headline S&P and so much fear in single stocks. What does that mean? Why is that happening? Why that is happening, why this is a record in single stock fear versus not a lot of fear in the headline S&P, it's because of earnings. It's because of how much weight Wall Street is putting on hyperscalers to maintain their AI guidance. Okay, that's all. Now, wouldn't you say if people were this fearful about single stock earnings, like your hyperscalers mostly, that you're probably set up for an upside surprise unless it's a disaster, right? If people are really fearful heading into a stock's earnings, it doesn't take a lot for that stock to do really well. Now, I don't think it matters if the hyperscalers go up or down following their earnings, okay? Because I think the broader market rally is going to be related to AI. It's going to be the momentum stocks coming back to life again because of things we'll talk about in just a moment. The only thing that matters for this broader market rally necessarily with earnings is AI guidance. Okay, let me tell you now. Meta, Microsoft, Alphabet report Wednesday and after hours. Thursday and after hours, that's Amazon and Apple. Do we really think that these companies are going to lower AI capex? Like, who is smoking the good shit out there on Wall Street that is really nervous about that? This is an existential crisis for all of these companies. You know, CoreWeave and Nebius and Applied Digital and these data center companies that are specifically tailored to AI workloads, they are coming to eat Amazon, Microsoft, Oracle, and Google's lunch. If Google, Amazon, Microsoft, and Oracle do not compete, do you think those four companies have a choice whether or not they want to buy AI chips? No, they don't. They have zero choice. Google literally said that. If Google stops investing in AI, their business is dead. Okay? I think it's the craziest thing. I mean, it's pretty typical, right? Wall Street gets nervous around AI and hyperscaler earnings, and then every time we're pleasantly surprised. This time is no different. Besides this time, there is a lot more fear. I think because those stocks have went up a lot. Okay? What do you think is going to happen after big tech earnings next week? Volatility is going to collapse, and Wall Street is going to start buying the markets like crazy. Okay? See, it's funny. Hedge funds and institutions. Why do you think retail investors outperform hedge funds and institutions on a regular basis? Why do you think hedge funds fail to even beat the S&P 500 80+% of them? It's so stupid. Because as volatility goes up, as stocks potentially come down, what does Wall Street do? They sell stocks. The more stocks fall, the more they sell. Okay? Like April, Wall Street was selling like crazy. Markets are down 20%. You should be buying. Okay? It's not how Wall Street operates. It's not their fault per se. They operate from a playbook of they want to survive. Okay? They have a fiduciary responsibility. If we have a depression, they don't want to lose all of their clients' money. Okay? That's essentially why Wall Street underperforms versus retail. Retail goes out and they buy the 20% dip. Okay? As they should. Right now, the VIX is so high in equal weight in single stock fear that there's not a lot of buying taking place. That's why you've seen a lot of selling in momentum recently. Okay? What happens when equal weight volatility collapses next week? The buying spree begins. Okay? Again, Wall Street should have been buying these quality AI stocks for weeks now. Retail has been doing that. You have been doing that. I have been doing that. Okay? They will start to buy when those stocks start to rally again. When equal weight volatility comes down. Okay? A lot of these firms, like, it's not even a conscious decision they make. A lot of these firms are pre-programmed where if volatility goes up in the in the VIX or like the VIX EQ, their algorithms automatically sell stocks and de-risk, right? The exact opposite should happen. But again, they operate like a fiduciary. They don't want to blow up their portfolio if we had a depression. Okay. So that's the number one reason why, in my opinion, it's a guaranteed home run rally is coming into the end of this year. Unless there is some kind of universal disaster with AI guidance from hyperscalers, which I view as less than a 1% chance, you're going to have a massive rally. There's no other way to put it. Whether, you want to participate in that or not, that's really the choice that you should be making at this point. Do you want to sit the next 3 months out, which is going to be one of the best 3 months you've ever seen? Or, do you want to be involved in that and make money with that? Okay. And I see a lot of people that are bearish right now, and a lot of people are going to get left behind in this. Okay. A lot of retail is going to get left behind here and end up chasing. I know a lot of people personally that are all in cash. You're going to get left behind quick as hell. Okay. That's a fact. Now, the other big event we have next week is on Wednesday. We have the Fed. The Fed at 2 p.m. and the Fed at 2:30 p.m. The Fed is going to be bullish. They're going to be dovish. There's not going to be much of a change from the Fed. Now, Wall Street is always a little nervous every Fed meeting that the Fed's going to be bearish, right? That's just how Wall Street is. The Fed is going to be really bullish this time around. The Fed funds rate monitor tool is pricing in a 100% chance of a cut this upcoming week, and basically a 100% chance of a cut in December and another cut in January. Then we're pricing in a pause. So 3 back-to-back rate cuts from here. I don't think that's going to change after the Fed. But JP Morgan, and this is a big wild card, JP Morgan says that the Fed is actually going to stop their quantitative tightening, which gets a little confusing for newer investors, okay? But the best way to understand this is like a dividend stock. If you own AT&T or Coca-Cola, let's say the stock is at $100, okay? Let's say you get paid $1.25 per quarter, which equals $5 a year. If you bought that dividend stock at $100, you bought a 5% yielding dividend stock. Well, assume that Coca-Cola or AT&T keeps their dividend the same, but people start to sell Coca-Cola and AT&T for whatever reason, okay? Let's now assume that stock, Coca-Cola or AT&T, is at $50, but they still pay a $5 dividend per year. So if you're buying that stock at $50, your dividend yield is 10% a year, okay? That's how it works with quantitative tightening. For simplistic terms, the Fed is selling, let's say, 10-year treasuries onto the marketplace, okay? Just like AT&T, Coca-Cola's dividend, the dividend does not change from the government. The government does not wake up one day or 1 year or 10 years from now and say, yep, we're going to pay a different dividend yield, okay? It stays the same. What changes the yield is the price of the bond. Now, the Fed if they're selling bonds onto the market, it would be like if Warren Buffett was continuously selling Coca-Cola, the yield would probably stay elevated, right? It would probably, the yields would probably keep going up. Okay. Well, if the Fed really does stop quantitative tightening, basically just selling bonds onto the market, then there's going to be less selling pressure. Bond prices can go up and yields can come down on the 10-year treasury. Now, they own all kinds of different assets on their balance sheet. I'm, again, trying to do this as simply as possible for some of the newer investors so everyone can understand what quantitative tightening is. It's just like a dividend stock, okay? The government pays the same yield, okay? It doesn't change. The same amount of money you get paid for owning a bond does not change. Everyone gets paid the same amount for owning bonds. The price in which you buy it for changes, goes up and down. The lower the price is, the higher the yield. Okay? So the Fed selling bonds, driving the price down, has raised the yields over the years. As the Fed stops doing that, bond prices can go up again and yields can come down. Okay? I know, it's a little complicated, but if you want to come join the trading community, we'll talk about this a little bit more in depth so everyone is on the same page over this weekend. Check that link out down below in the description of today's episode. So I view the Fed as a uniformly bullish event, right? Fed's going to cut rates. They're going to give guidance for future cuts, probably stop QT. Bullish. Earnings are going to be much better than expected. Guidance is going to be raised by the hyperscalers for AI. They're going to have great things to say about AI. They really have no choice. Single stock volatility is going to collapse, and that is going to fuel a chase on Wall Street into the end of this year. That's how this is about to play out. Now, we did get some really good news today that trade talks in Malaysia between US and Chinese officials were quote unquote constructive. That's great. Ontario is not anymore running their Ronald Reagan negative tariff ads that caused Trump on Friday to cancel trade talks with Canada. Seemingly, Trump and Canada are going to start negotiating again. Okay, so the positive catalysts are really starting to stack up here. Share this clip with you again from Tom Lee. Tom Lee says, I think you're going to see a crypto rally into year end. But I also want to share this clip with you from Warren Pies and 314's research. He says S&P is not overvalued and end of the year rally is on. This guy has been the most accurate person in judging this market, at least over the last 2 years that I've been following what he's said. Okay, nobody comes close to being as accurate as Warren Pies. But first, I want to start with what Tom Lee says, and trust me, you do not want to miss these two clips.
Coin rising back above 110,000 this week, and the Nasdaq posted a record close. So is this a sign that the risk-on trade is back in full force? Well, let's ask one of the biggest bulls on the street, Fundstrat's Tom Lee. Tom, happy Friday. So we're up more than 15% year to date for the S&P, probably more than you expected in late spring. At the same time, we had this government shutdown, tariff headaches. So why should investors be more bullish on risk assets, the market overall, than they were 6 months ago?
Well, John, even at the April lows, just to be clear, our S&P year-end target was 6,600. So we were still expecting explosive recovery in markets. But we are above that level. And, we're 10 weeks before the end of the year and the S&P is at 6,800. I think it's still a base case then for people to say that in just a typical year, the S&P should gain another 4%. That would put us over 7,000 into the end of the year. And I think that that's sort of the minimum. But because we've got the Fed cutting, and they started in September, they've been on pause all year. That only happened twice in the last 50 years, which is 1998 and 2024. I actually think the S&P given the skepticism that's been plaguing this market all year, we could do far better than 4%, maybe even 10% into year end.
Wow. Okay, so where does crypto fit in, especially when you're looking at how those currencies are moving versus what's happening with tariff concerns, global trade concerns, et cetera?
Crypto had a huge deleveraging event on October 10th, and part of that was triggered by the escalating tensions with U.S. and China on tariffs and trade. And that was the biggest liquidation event in 5 years for crypto. So there is still those ripple effects, 2 weeks later that are plaguing the crypto market. But I think we're almost through that, because a measure like something called open interest for both Ethereum and Bitcoin are at record lows at a time when the technicals for both Bitcoin and Ethereum are flipping positive. So I think you're going to see a crypto rally into the end of the year. And it really does help to see JP Morgan say they're open to the idea of using crypto as collateral.
Yeah, I was actually going to get your thoughts on that, Tom. But in light of that, and you and I have had these conversations over the months, over the years. I can think about the conversation we had in early August where you talked about, on the exchange, where you talked about the fact that cryptocurrencies tend to be early indicators of where stocks are directionally headed, as well as indicators of liquidity in the broader market. So given what we are seeing in Bitcoin, and as that relates to the S&P 500 and arguably what we're seeing in Ethereum and what that says about the Russell 2000, I want to get your thoughts.
I think it's sending a pretty bullish signal. Part of it is it's a counterfactual statement, but crypto had the biggest liquidation event, deleveraging event in history. The number is probably multiples of what happened during FTX, and Bitcoin ends up down 3 or 4%. So I think it shows you that Bitcoin itself is proving to be a pretty good store of value, because if we had seen this happen with gold in the gold market, if there was a huge deleveraging event and gold was only down a few percentage points, we'd of course consider that a real validation. And it's also true of Ethereum, because Ethereum is seeing so much activity growth. On the L1 and the L2 because of stable coins, and it's not reflected in the price. It does take time. So to me, because like what I'd call the fundamental activity on Ethereum is really picking up, it argues for a pretty big move into end of the year as well.
So boom, Tom Lee says we're looking at least 4% upside from here. That puts you at about 705 into the end of the year, but it could be closer to about 10% upside, which would put you at about $745 on the headline S&P, and I'm more in that camp, for the reasons we've talked about in today's video. Now, I really want to share this video with you from 314's research, Warren Pies. He says S&P is not overvalued. An end of the year rally is on. Take a listen.
We're joined now by Warren Pies. He's 314 Research co-founder. It's good to have you. Welcome back.
It's good to be here. Thank you for having me.
I guess that is the question. Just how far can stocks continue to go up? They don't seem to care about anything other than what's right in front of it. Earnings are good, rate cuts are coming, and the economy's strong. I don't care about tariff headlines. I don't care about this, and I don't care about that. Is that where we're at?
I think you're right. It's difficult to make a near-term bear case. I think we came through. There was a test for this market coming through the summer. It's a seasonally weak period of the year, and we had all these systematic buyers that I've spoken about with you on the show, full of stock. We had corporations, which have been a big support to the market, step away during that period of time, and we had excess sentiment. Our gauge of sentiment was at 70, which is extreme. Anything over 60 is optimism. That's come back down to 50. So here we are. We're entering into the seasonally strong period of the year. Sentiment has corrected. These systematic buyers have normalized their positions, and corporations are coming back in aggressively at the end of the year. And so we take all that, put it together, and then we say strategists still have their median target below where the S&P is trading out to year end. When you look at all the Q4s where that condition has been at the start of the Q4, we're higher every year except for 2012. And so with an average about 4%. So you can project that out. And I think that's what we're looking at here. That's the base case. It has to be the base case.
I left something out. I mean, there's a really interesting story that's moved in the last, I don't know, hour or so by another news organization where they're quoting Citadel Securities' Scott Rubner. He talks about how powerful retail demand has been, that it continues to act as the price setter of this market. Retail traders responsible for 22% of trading volume in U.S. stocks. Individual investors have been net buyers of U.S. stocks in 23 of the past 27 weeks. What do you make of the power of the retail cohort, whether we are giving that group enough credit in the role it's playing in this rally?
I think it's changing models in real time of how we look at this market. And I think it explains, I just laid out the case, like many institutional investors were cautious over the summer, given what I just laid out. And retail carried us through. And Scott's work aligns oftentimes with our work. And I know that, so you have that retail bid, and then corporations come back at the level that we expect them to come back at, more than $1 trillion annual run rate that we've seen this year. That's a powerful combination. All these systematic buyers, and you throw retail in the mix. What it means is that we can reset sentiment and reset maybe that 3% correction we got in October was everything we're going to get, and I think that's a little bit surprising and shocking to the institutions. But yes, retail is buying the dip. I think it's part of this debasement trade we've been laying out for a while.
Yeah, I mean, maybe driving a lot of stuff. The momentum trade, certainly the meme activity. The other point that he makes is that you're going to start to get buybacks again starting next week, right? We've had the blackout because of earnings period, and now you're going to throw that into the mix too?
Yeah, like I said, that's exactly what we're seeing. We do seasonality of buybacks, and that really ramps up here in about a week. And so that explains a lot of the seasonality that we see. So one of the things we saw is that during the April-May period, when we had all of the tariff drama and the market was selling off, corporations were as much as 8% of buying activity in the market. And so that was crazy levels that we've ever seen. So anytime we see corporation buying more than 1% of the volume in the market, we tend to have strong days out of the equity, out of the S&P 500. And so you're talking 8, 2, 3, 4, 5% regularly throughout this year. It's along with retail, like I said, it's a lot of buying pressures, like trying to hold a beach ball underwater. It doesn't work with the math there. So yeah, you have to be bullish to year end. And then the other thing we hear is, valuations, and we've done a lot of work on valuations, and I don't see this market as really being overvalued, to be honest.
Now, specifically for Tesla stock, I want to talk about this, okay? We're talking about an end of the year rally into December 31st, into the, first part of 2026 at the bare minimum. That's my call. That's my expectation. There's really no other way to put it for you. Like, if this should be clear, an end of the year rally is coming. It starts this week. In my view, again, I'm not a financial advisor, not a financial planner. Read the disclaimers down below. Come join the trading community. There's even more disclaimers over there. Okay. Could be wrong. Shit can happen that is unforecast. But for Tesla, November 6th is the big day. I think Tesla can trend higher into November 6th. Okay. But after November 6th, assuming Elon's compensation package is passed, that is when Tesla stock goes parabolic. That is where Tesla could be a $600 or $650 stock by December 31st. I mean, you're looking at substantial upside potential after November 6th. But between now and November 6th, I'm expecting modest upside. Getting back to 488 would be a good level. That's about 13% upside. 500 is kind of the max that I think we could hit before November 6th. That's 15.3% upside. Just because November 6th is such a consequential day for Tesla, it's the biggest day in Tesla's history. Okay. It's either going to be really good or really bad. It's black and white, either really good or really bad. That's why it's important that you go out and vote your shares. I voted in favor of what the board wanted to do on all proposals. You can vote however you want, but go out and vote. So that is going to do it for today's episode, ladies and gentlemen. Hit the like button as well as subscribe to the channel if you have not done so already. Have a great rest of your day, and I will see you in the next one. So hopefully you learned something. Hopefully you got a different perspective than maybe you thought before out of this video. If you guys, again, want to come trade with us, check that link out down below. And I say trade with us. We do make short-term trades, but really we're trying to invest and identify the big winners over the next 12 months, right? We're not necessarily going into a stock just for, let's say, earnings and then having the idea of selling out. Like if I buy a stock, I don't really care what happens over the next 12 months to it, right? The thesis is there. The XYZ reasoning is there. I want to give it some time to work. And that's the kind of stuff that we are doing over there. Yes, trading every now and again, certain opportunities, stocks are going crazy. Like if there's a stock I don't want to hold long term, but I want to trade it, we're doing that as well. Okay. But most of these stocks are kind of medium term time horizon opportunities. So check that out if you guys would like to. Link down below. Hit the like button as well as subscribe to the channel if you have not done so already. Have a great rest of your day and weekend. I will see you in the next one.